Hello and welcome. So in this one for personal finance, we're going to go through retirement planning. So this is essentially going to be everything from what to do accumulating all the way to going through the point of at retirement. And we'll cover off some tips and kind of things how to tackle this along the way, because it can be a bit of a unbeknown or an unknown kind of feat that you've got to try and tackle yourself. So hopefully this will create a little bit of guidance for you anyway. So let's jump into it then. So what we're going to cover in this is why plan in the first place. So it gives you peace of mind, future you want, etc. We'll cover all that off. When to plan, how to plan, and then the other tools that you can potentially look to use in your retirement and actually looking to actually achieve what you want to achieve. So why plan in the first place? Well, when you have a plan or a map, it's much easier to get to the destination that you want. So this can be if you're wanting to retire early, if you're wanting to retire on a certain amount of income. At least if you know where you're going with it, it just creates a lot more sort of stability, really. You also owe it to yourself. So because you work many years and you're saving to your pension, or you just save in general or through property or whatever method that needs to be, you kind of owe it to yourself really to be able to be in a position to live and retire without sort of having to try and, hold on to any little bits of money that you might have because of the anxiety that you've got around it. And then also just to consider, is winging it really kind of an option as well? So what's your goal? So I've got a sort of table up. That table essentially just gives you the different types of retirement you could expect. This is actually from the figures from the Retirement Living Standards. So this is what they've calculated based on average people, whether you're single or as a couple, and what you could expect to need in retirement. So as you can see, you've got minimum, you need 12,800 as a single person, and then as a couple, 19,900. Then you've got moderate for a single and couple, and then you've got comfortable as well. So as up to 37,300 for a single and 54,500 as a couple. And that just means, well, what does that mean? That essentially means that this is what your retirement could actually potentially look like. If you're single and you've got that retirement of 12,800, that could mean, well, are you able to do any sort of housework? So we've established that DIY maintenance and decorating might be one room per year that you're able to do. You got £54 a week on food, which obviously not a great amount, and that includes eating away from the home. Potentially got no transport or no car. A week and a long weekend in the UK every year, up to £580 for clothing and footwear each year, and then £20 for sort of birthday presents and things. So not a extravagant, but that is kind of the minimum amount for most people that they need. And I'll come on to how we sort of plan this out and how we establish these figures a little bit later. Then you've got moderate. Again, it's basically just expanding on what you're able to sort of live off. So you've essentially got, you've got a 3-year-old car in this example, and you're able to spend £791 on clothes, £34 on birthday, so a little bit more. And then you've got comfortable, which again is sort of leveling it up one more really. 3 weeks in Europe each year. You got more that you can spend on birthdays and holidays. It's just it's kind of just a tiered, pretty obvious tiered really. And these are just average figures for people and what kind of life the average person might want to achieve, whether that's minimum, moderate, or comfortable as well. So it's quite handy. I'll put the link to the actual website in this so you can have a look through, and it kind of drills down a little bit further into what you could expect, and also the different kind of tiers to that as well. So having a plan will take out some of the anxiety and not knowing, and potentially move some anxiety. So essentially having a plan and having something that is at least mapped out. It might not be the end goal or the thing that you think, right, this is exactly what I'm going to do, but having a plan at least means you're steering in the right direction. So it helps take out that stress of not knowing, and also the anxiety of going, what is my retirement going to look like? What am I planning on doing? Am I going to be able to go on holidays? What am I going to be able to spend my money on? I'm going to have more time with the family, whatever that may be. It just gives you a bit of peace of mind, or at least kind of holds up the mirror really and says, right, this is what the situation is. Then we've got if you didn't know, or would it not be better to know so that you can make adjustments? So if you're falling short, you could be thinking, well, what do I need to do now? Because the sooner you jump on it, the better. What do you do now to be able to actually get to that point? Or it might actually be the other way, and you go, well, I'll be comfortable with that type of retirement. So that means you can actually spend more of your money now while you're perhaps more youthful, or you've got children, or whatever the situation is. You can think, well, I'll be comfortable with that, and at least so there's no right or wrong for it. And people say to me, or I've heard people say, well, they take it away anyway in care costs and tax and everything else. Well, yes, if you don't plan correctly, but if you plan things out and you map out that plan, then not to say you're kind of avoiding it, but you're just able to do things quite cleverly to help mitigate it, essentially. So the tax side of things, you can do quite efficient tax planning, and then also around care costs. If you plan things out a certain way and you can put properties in trust, you can sever tenancies on properties, you can certain investments and things that you can use so that then you're actually, again, safeguarding your retirement as best as you can, and fundamentally not relying on the state to dictate, right, this is the care you've got to have, and this is the type of care you've got to have, or you've got to sell this asset because you've got money that you're sitting on. Lots of different things to consider. That's more around later life planning and care costs, let's say, but it's something that does very much factor into retirement planning as a whole. So when to plan? So different points in your life. So when you're younger, you're in the more accumulation phase, so from 18 to 40. When you're middle age, your accumulation is, or your accumulation / preparing for decumulation from 40 to sort of 60. And then at retirement is anything from 60 onwards, really. State pension for most people is sort of 67, 68. Some people have occupational schemes that are sort of 65, even slightly sooner than that if you've got old historic ones. So hence why I've put sort of 65 plus, really, to give you a bit of a ballpark. And depending on what age and at what stage of your life you're at, really dictates what kind of you're going to be doing with your investments, and also what your outlook on how you want your retirement to look going forward as well. So I always say to people, the best time to plant a tree was 20 years ago, and the next best time is now. So that is quite key with your retirement planning, because if you start as soon as you can, pretty obviously you're going to have more time to invest. And the biggest thing to get a bigger retirement, whether you're looking just to invest some money for something, it doesn't have to be for retirement, whether you're just trying to get capital growth, whatever your reasoning is, the biggest asset you literally have is time in the market. So the longer you're in it, the more you're going to benefit. So you can't necessarily time the market and know when things are going to go up and things are going to go down, but the longer you're in it, sort of proven over historical events and everything, that it actually means that you're accumulating it, and your wealth and your assets that you hold have chance to compound over time. So that's kind of what I'm meaning by that quote there. And most people think that retirement planning should be when you're actually at the point of retirement, but it's just not the case. The sooner you do plan, the sooner you're going to have a roadmap to get there. And even a little bit earlier on can have such a profound effect when you actually get to the point of retiring. And if you are at the point of thinking, well, I'm 55, I'm 40 to 50, say, or around that age, and you're thinking, well, I don't really have much time, I think, well, you'd be surprised still how much putting a little bit aside for 10, 15 years up until when you want to retire, again, can have that compounding effect, because there's no short amount of time. And your retirement, in theory, should be for when you hit sort of, if you're able to retire earlier at 55 or 57, or if it's going to be sort of around state pension age, you're still going to have health being well, sort of 20 years or so, potentially even longer, the way that they're predicting that, the way that people's longevity is going now. That because of that, you want to make sure that you're going to have enough funds to last you that time. So starting earlier really helps sort of shift that as well. So when planning, think with the end in mind. So what do you want to retire on? And what do I want retirement to look like? Do you want holidays? Do you want more family time? Do you want your mortgage to be paid off? Less stress? There's no right or wrong answer. It's really just dependent on what you want as an individual. So some people might go, actually, I'm quite a introvert. I quite like staying at home. I've not really got any desire to want to go on holidays, but I want to spend more time with family. So are the family geographically close to you or further afield? Do you need to factor in travel costs in that? Or you think, well, you might not have any dependents, or your children are sort of flock the nest, whatever the situation may be. You think, well, I want to spend more time on holidays. This is the time for me or me and my partner. And actually just thinking, well, I need to come up with a sort of budget or a figure. But it's first thinking what the goal is, as opposed to just thinking what the monetary figure is first. So if you think with the goal, one, you're more likely to aim for it because you're thinking, well, this is going to get me holidays. This is going to get me a mortgage to be paid off. And that then creates the drive to then sort of stay on course, really. But also, it's not just, retirement plan is not just about the figures. It's about what you want it to look like and the emotional aspect. So that's quite an important one to sort of keep at the forefront, really, and not get bogged down too much by the figures and the numbers and everything. Really think about what you want the goals, and I'd probably say do that almost first. Map that out, what your goals are, what you want to do, and then from there we can sort of work backwards in achieving what you need to. And don't forget that your retirement is a 7-day weekend. So you're going to have more time on your hands. So what are you going to want to do with that time? At the moment, you might work full-time, might work part-time if you're heading towards retirement. And you have to think, well, I'm going to have a lot more time on my hands. So even though now I don't spend money on that many holidays or going out just on the weekends, are you going to likely to spend more on sort of leisure and hobbies and things because you're going to have more time on your hands? The flip side is you're not going to be commuting to work, and all of this I'll explain how we do this in the sort of how to plan in a moment. So that being said, how to plan. So the longer you have, the more you can afford to ride at the bumps in the road. So if you're 18 to sort of 40, as I mentioned earlier, and you're in that kind of accumulation phase, just to give you a bit of a working example of how this looks from investments as a whole, you have a longer time horizon, which means that you can afford the ups and downs because you're not relying on that pension right now. You've got enough time for that to build up. And then at the point of retirement, that's when you might start changing what the types of investments are. So just as an example, make this a bit bigger so you can see. This is just a very simple sort of graph. There's no other indexes or anything. It's just one type of fund, and this is a Life Strategy 100% fund by Vanguard, which is 100% in shares. I'll explain what shares and bonds and different types of things in a separate video specifically on investments, but this is just a Life Strategy Vanguard fund. It's not one that I necessarily recommend for everybody or just throw into it. It's one that I've used for clients, and it's all individual on your situation. But this is, again, just a bit of an idea so you can see what it looks like. This is over a 10-year window. And you can see from that 10-year window how the sort of investment has performed along the way. And you see that gradual up and down. Now, if we to compare that to somebody who's closer to retirement and maybe even 1 year away, this is a 1-year chart. And you can see 1 year's looks very volatile. There's actually it doesn't look like there's any trend in what's going on. It doesn't look like there's any continual up or any continual down. It's just sporadic all over the place. And that's why when you're looking over a short time frame as 1 year, 2 years, even 3 years is such a short time frame in investing that it's very hard to try and get the great amount of returns without that volatility playing an effect on it. So again, when you're comparing what the 10-year is, you can see that upwards. But then when you zoom in on just 1 year, you see that kind of moving. And what we need to do is make sure that if you're heading up to retirement, that you're not putting all of your sort of eggs in one basket, or you're not essentially putting it all into shares, because you're going to see that volatility, because you're going to need that money, and we don't want it to be on a downturn that you then need to start drawing on it. So if you're earlier on, I'd say you could afford to take those ups and downs because you're not going to need it in 5, 10, potentially even 20, 30 years if you're looking to retire later on. Whereas if you're sort of 40, 50, we need to think about that more. And if you're sort of 60 and I'm actually approaching that retirement, or at the point of decumulation, which is where you take money from the pension, that needs to get factored in. So just a little bit around the funds as a whole. This is a sort of comparative one. That is a 1 year time frame, again, just to compare it with the 1 year before. But this one's a 60% equity with Life Strategy, just to compare. So you can see it's it looks a little less volatile. It's still not the most least risky, let's say, on paper, or it still holds some equity to get some growth. But what it does do is shows you that it's a little less volatile in the sense that the ups and downs aren't as steep overall, let's say. So it just gives a bit of a snapshot. And this isn't the most perfect example in the world, but I just want to be transparent with kind of how it works. It just gives you a bit of an idea and hopefully a little bit of methodology around when actually picking the types of investments. And it might make you think, well, what are my current investments with my current pension providers actually in? And what are they currently doing? And that all then might trigger, well, actually, I'm quite, I've got a nest pension, I've got whatever pension I'm in. I don't really know what the fund is. Maybe I could afford to take a little bit more risk because I'm such a long time horizon before I invest that I could think, well, because that's such a long time horizon, I want to make sure I can get as much potential growth and sort of change the investment as you get closer to it. And it can be a real detriment when you get automatically put into a pension from your employer, or you've got one that was set up years ago and you haven't done anything with, and it's essentially just left there. And you might have been, I've spoke to clients that have had pensions for 20, 30 years through employers or through different situations. And I look at the investment and I'm like, this is in a really type low risk fund, which might suit their personality because they don't want to see that volatility. But the likelihood is a lot of people just don't check the pensions on a daily or weekly basis. So actually, when they come to check it, it's like, oh, it's done okay. But then when I start looking at the data behind them, like if they were in this type of fund and we sort of back test it, it could have been worth this. And I don't really like that idea of speaking to a client, or if I had a client and looking back and going, well, if they were like this, they could have had this. So you need to kind of make sure that it's suited to you. And then the flip side, if you're really nervous, there's nothing wrong with having a slightly more steady Eddie type investment if you're comfortable with the returns are not going to be as high. So the thing that you need to factor in there is also not just the returns and the figure, but the emotional aspect. You don't want to be sleepless nights thinking, oh, is my pension going up? Is it going down? That's why it's so bespoke to each individual, because it's your journey essentially along the way. So let's just go on to next slide. So work out how much income you need in retirement. So this is the sort of diving into the how-to a little bit more now. So know where you're at currently, because that will essentially give you the starting foundation. And then what we'll do now is we'll break it down and how we actually plan this out. Again, if you want this sort of budget planner, it's quite a straightforward one. I use this one for some clients who do have a slightly more complicated one, but this one is one that I've essentially created. So if you want to use this, just either email me or drop me a message and I can fire it over to you. It's not a problem. And if you're not very good with Excel spreadsheets, which this is in, so it's got formulas, don't worry. I've also downloaded it as just a PDF, which then you could print out and have a calculator and a pen and literally just fill it in, because it doesn't need to be complicated. So first thing you do is look at your income. So what income do you have? If you're single, obviously you just put one in. If you're a couple, you put those in, and put all your income sources at present, and knowing what you're going to sort of what that's going to look like. So are you employed, self-employed? What does that look like? Do you have rental income? Do you have any sort of pension or any investment income? Or do you have a pension because you're 55 and you had like a military pension or a police pension that I've kicked in earlier than other ones? Do you have that as a regular income now? Or like sort of like council pensions or public sector pensions, things like that? And also, do you receive any childcare or any benefits or anything like that? It's worth putting all of those in so you've got complete transparency of what comes in, maintenance payments, the whole kit and caboodle. So do that first. You map what your income is. Then you put down what your outgoings are at present. So not thinking about your retirement yet, but at present. And you will put down everything from your mortgage or your rent. You'll put down home insurance, water, gas, electricity, TV license, everything. And if you get a bank statement, the best way of doing this, it also kind of makes you realize all the little things that you may be spending money on that you don't need to, extra subscriptions to things that you don't quite know. The amount of times I've come across clients that when I'm going through bank statements, and if I'm doing a mortgage and I'm going, I've looked at Misters and looked at Misses's sort of bank statements, and in both, it's like, well, you're paying for Amazon Prime and you're paying for Amazon Prime. Is there a reason why? And they're like, and then they go, oh, I didn't realize you were paying. And it was like, well, I didn't realize you were paying. I'm like, well, maybe you just use one and cancel it, or even Netflix. That's happened so many times. And if you're clever and you use kind of each other's, obviously cutting down costs, pretty obvious, really. So yeah, going through this with a fine-tooth comb gives you a current situation of where you're at now, and it gives you that foundation and starting point, so you know exactly where the hell you're at. So put all that down, even what you might spend on holidays, any other expenses. You might have sports holiday or sports activities. You might do golf, you might do shooting, whatever you decide to actually want to do, horse riding, anything like that. Just put it all in so you know what your current situation is. Then what we look to do is, the next thing I would say actually, so do that first. Then because you've got your income all down, the next thing to do, and part of it, is you can establish emergency fund, which is kind of a bit more budgeting. I've covered it in a previous live as well. But what it means is, because now you've got all of your expenses, at that point, it's easy to figure out, well, what's 3 months worth of that I need to cover? And in this case, for these clients that had joint income of 4,500, you've then got what you need as your outgoings covered. So they spent everything, savings, investment. I've kind of put it down as a dummy client, really. But then we've kind of spent everything that they had. Some going into savings, some went into just general spending and fuel. All those expenses added together, times that by 3, gives you 3 months worth of those outgoings. And that really should be, if you're accumulating towards a pension, or you've got a mortgage, or you've got children, that should be your minimum foundation, really. Or not really, it should be your minimum foundation, so that you're not using credit cards and things like that. So it's just kind of a bit of a tip along the way. If you've gone to the effort of putting all your expenses down, you might as well just add them together and times it by 3 and go, right, this is the figure we need to save to, just to put simply just to put into a savings account, joint savings account, ideally if you're a couple, so that it doesn't get locked if something happened to one of you, so that both can access it in those times of need. It's just again, you've gone to the effort to doing it, so you might as well do that along the way. Then you do what your retirement outgoings are going to look like. So what you do in this example is, now you've listed down all of your current situation. Now you list down what you think, to the best of your ability, your retirement is going to look like. So in this case, you can exclude mortgages if you're going to have that paid off, which I've done in this case. You might be able to exclude sort of travel costs, because you're not commuting to work every day unless you work from home. You might be able to take out other different things. Certain insurances you might no longer need. For instance, if you've got your mortgage insured and you don't have a mortgage, you might not necessarily need it. Or if you're no longer needing to cover your income, you might not need certain income protections as well. So you can start to scale things back a little bit. In this situation as well, cars and finance are going to be paid off. So, if you're planning towards it and you're really streamlining what you need to live off, children might have moved out. So you can start to list down all of those things. So put the monetary figure, but then also put why is it different in retirement, so you can actually give it a bit of rationale and know more in more detail why that is the difference. And also, if you're a couple, it's quite good to hash that out to see, are you on the same page with things as well, and what is your retirement going to look like together. The other one is, you might actually increase some outgoings. So in this case, I've put your holiday. You might want to spend more in holiday. You might have leisure activities, so actually up to the amount that they might have in this case towards that, and then what that looks like as a total, essentially. So quite straightforward to do, but it can seem painful to go through. But you'll be surprised once you get into it, you start actually getting a bit more excited and going, right, we've got this. This is what we want it to look like, and see it as a bit of a positive thing to do, really, because it is. So then, what you do is, how much do you actually need? So in this situation, for all of these, if I just go back one, all of these added together as a total, that will be what the amount is that you need. Then what you essentially do is, once you've totaled all of those out, you then need to know, well, what is that going to be for the year? So you times that by then 12. So you've got the monthly expenditure in your retirement, times that by 12, This is the yearly amount that you would need to sustain yourself through retirement. And in this situation, it was 29,640. So that is the amount that this couple would need for their retirement to sustain them throughout. Then what we need to do, which is where that it says at the very top line that you can see, it says income required net in retirement, PAs per annum. I just couldn't fit it in the box for the full word. So essentially, you've got 29,640 is the total amount that they need. Then we've got grossed up income required at 20% tax. So this means that because retirement and when you get to retirement income and even your state pension, anything else is taxable, you need to make sure that you're saving enough to factor in the fact that you may pay a tax charge. You might not have to if you plan it correctly, but I always say it's better to err on the side of caution and assume that you're going to pay. And if you are paying 20% tax in retirement, you're doing a good job to have enough income in retirement. So don't see it as a negative. I know it's, oh, I've got to pay tax. But if you're paying some tax in retirement, it means you've got quite a comfortable retirement. You're not just living to the breadline. So again, I almost see it as a bit of a well done, really. Then you've got things that you would then deduct out of that. So what can you reduce that amount by? So that 29,600, it's then been grossed up to 37,000. What have I already got? So that's planning. This assumes at the minute that 37,000 assumes that you've got nothing at all. What have you actually got? So state pension is one that for most people they will have. And as a couple, jointly together, if you both retired at the age of 67, 68, depending on your date of birth, when that kicks in for a joint couple on full state pension credit, which is 35 years to accrue, is £21,240. So that is the amount that is guaranteed once state pension kicks in that you will get for the rest of your life. So again, check what your state pension forecast is because you need to know what you're going to be receiving and add that together. And if you're falling short, you can add contributions to it, or at least when you know you get to retirement, what will it be? So just check what your state pension is and deduct that out. The other thing to do then is also deduct out anything that you might have, any other personal pensions, any defined benefit pensions that you might have. They can all go in and you put the yearly amount in, and that will essentially minus those off your goal of 37,000. Then what's left over is the yearly amount that you need to be able to achieve the retirement that you need based on your outgoings. So in this case, we've done the total of all of the things. So state pension was the only one in this situation that I assume the clients had. So 21,200, that's minus off the 37,000 gross, which is again the before tax part. Then the difference is this, the shortfall needed to be provided by private pension. So 15,849. It's quite small, I had to double check. So that amount there is the amount yearly that you need on top of state pensions to achieve what the retirement they want to look like. Then as the last final stage, well, what do I need to save to enable me to have that? Well, a really simple way, and this is really simple and not going down any complicated things because I wanted to keep it as basic as it can, just to try and get some people on the way, really, is the capital required. There's a rule that I'll explain in a moment of how it works, but the simplest way is that number, and I've put at the bottom at the tip. So you put that number at 15,849.60. You just times it by 25 because that's the way, and I'll explain this in a moment. Times it by 25, and that is the pot value, the personal pot value that you need in your pension to be able to withdraw 15,800 every single year to make sure it sustains you for at least 30 years. So it's quite a simple rule of thumb, and there is tweaks and changes that you might need to do along the way, but that's a really good kind of basic baseline for a lot of people that's quite easy for them to be able to do to get a bit of a head start on it, really. So, and for a lot of people, that can seem a lot more than they're expecting, which is why you need to make sure that you're starting as early as you can, or at least even if you know now what you're aware of, you can think, well, can we play catch up with it now? Can we put extra savings towards actually having our retirement? And what this will do now is give you the opportunity to go, well, I don't think we're going to be able to save nearly £400,000. So what is realistically our retirement going to look like? So will we need to reduce down that extra bit of money, that 15,000 a year that we need on top of state pension? We need to reduce that down, which then means we need to cut back on certain things that we need in our retirement, so our budget. So it might be restricting leisure activities, it might be restricting certain hobbies and things like that you go, right, or holidays, that you sort of cut back on that to make it more achievable for you. Or you might be the other way and go, well, I've got like a couple of pension pots already, and with those couple of pension pots we can then reduce that down. So a few things there. Just to recap, you find out what your outgoings are likely to be in retirement as a couple or individually, figure out the yearly amount, so times it by 12, deduct, and then make sure that you've got the gross amount, which is basically 20% of that. The spreadsheet I can send you will calculate all this for you, but you essentially need to like gross it up by 20%. You then deduct that, or deduct any pensions you currently have, military pensions, state pensions, any other defined benefit pensions, government pensions, any other personal pension pots you've got that you would deduct off that. If you've got a personal pension pot, do times that by 4%, and that's the amount that you will that you'll need to put in that box, because you need to know what the yearly amount is. So 4% is the amount you'd put in that box for the yearly amount. All of that will minus off what you currently need to achieve, and then that amount that you need to achieve is what then you times up by 25 to figure out kind of your shortfall or your goal and aim, depending on where you're at retirement. So I hope that makes some sense, and it can seem a bit overwhelming, but once you start doing it and crunching the numbers, believe me, it just starts flowing and just starts to make sense, and you start to get a bit more enthusiastic about it one way or the other to actually decide, right, this is what we're going to do. Right, we are running short. We want this retirement, so let's push for that, and it can give a bit of a kick really to get in there. So find out what pensions you currently have. Do you have any other defined benefit pensions that can reduce that? In this case, was nearly 400,000. Can that reduce that down? Have you got any personal pension, multiple different pots? And a few things to consider would be, is it worth pulling those pots together, consolidating them, because you've got so many all over the place, it's hard to manage. Pulling them together, you just need to make sure that it's cost effective to do so. Is it that one platform provider that you have one pension with is better than the other one? So maybe move them to one or move them to the other, and just make sure that the costs and everything weigh up. But pulling them together can just give you a bit of an easier oversight of your pensions as a whole, which then gives you more control, because you go, right, I've got one pension pot to be able to do these things. Then if you do decide to consolidate them, or even if you don't and you keep them where they are, the thing to do then is look at what the actual investment is in that pension pot. Are they invested in what you want? Are they invested into something that's going to get the potential growth? Are they too volatile, and you're thinking, well, I'm actually trying to save and get to retirement, I don't want it to be going up and down too much, I need to just make sure it's more slightly more level and less of a roller coaster ride. So having a look at what the funds are as well, because you want to try and squeeze out what you can out of what you've currently got as well, on top of building on top of what that is as well. So just a few things to consider, because it might seem a lot of money, but if you start factoring all these other little pension pots in, you're obviously just reducing that down, and it's your money, and you want to make sure you're squeezing out what you can from your current pension as well. So quite an important one. So just to explain what the 4% rule is. So the way the 4% rule works is, in the year of retirement, you calculate 4% of the balance of your pension. So I've done the flip reverse of this. So when I said times it by 25%, you're actually doing the reverse of that. So that 15,000 times by 25 is giving you what the pot value is, and the 4% is the 15,000. So I hope that makes sense. So yeah, you calculate 4% of the balance of the pension, and then withdraw the amount in pounds as an income. Each subsequent year, you need to take previous year's pounds value and then adjust it for inflation. So I'm not going to go into how to do that specifically, because it's a one step further, and I just want to get enough information over to you to be able to essentially just get a plan started. And then when you get to retirement, that's usually where advice starts to becoming more pertinent as well, and people think, well, I need to start mapping this out more accurately. But this is a really good starting foundation. Then take out the amount in pounds. Then this should allow your income to continue to be paid for the next 30 years, which should hopefully be sufficient to provide you with an income for the rest of your life. If you're needing it longer because you want to retire sooner, you can do it by 3% to sort of make sure that you're maintaining that. The other way is, instead of thinking, well, I'll do it by 3%, I always say to people, what you don't want, and what I don't want for my clients, is that they have a big pension pot saved and they haven't had a chance to spend it as well, because it's your money and you want to be able to utilize that. So some clients have gone, like I've got some clients that are 75, 76, and they're well into the retirement. And I've sort of said to them, well, you've still got quite a big pension pot here. Why don't you look to try and spend some of it? And it might be because they want to pass that down to children, because pensions are extremely good ways for like inheritance tax plan to pass it down, which we've done for some clients. And other ones, it's a case of, well, they just like having a slightly larger buffer in the pension, which is fair enough. There's no right or wrong answer, but I always try and persuade clients to say, it's your money. Why don't you start to spend it and enjoy it as well? So it's finding that balance between, do you want to retire sooner and make sure you keep your pension going as long as you can, or if you've got a larger pot towards the end, actually start spending it. Start using your money that you've managed to save up. So another example that you can use, it's one that's, you can get ones that retail clients is what people are called, who don't invest in things necessarily, or who are not au fait with investing as a whole. There is basic versions of this that you can potentially use, but the software that I use as a financial advisor is, it's paid for service and everything, and it helps sort of crunch the numbers a bit more and gives a more accurate forecast on what your retirement's going to look like. So you put in what you're currently going to earn at the present, and then when that drops off, so you can see where the big dip is there, that's where you drop down, and then you can put in state pensions, other pensions, other defined benefit pensions, personal pensions. You map all that out, other investments, property, if you're going to be having rental income, you can put all of that in to factor it in, and then it will be able to calculate what the likely shortfall is, and then be able to stress test it as well. So we'll be able to go, well, this, in this situation, if everything went, tickety boo, and it went along nicely as we needed to, well, there's going to be no shortfall. But if markets were to drop, and if markets were to drop early into retirement, that can have quite a big impact, to be quite honest. So if you retire and then the market drops the second you retire, I won't get into the financial lingo of it, but essentially it creates a bit of a more painful effect long term, which means then the shortfall drops off a lot quicker. So we start stress testing and go, well, if this was the situation, this is what it would look like, or if this was the situation, that's what it would look like instead. So we do plan it out to make sure that there isn't, we just try and come across with all eventualities as best as we can. There's no, sort of silver dagger or anything, or any kind of one answer that is the definitive, but we try and forecast across as many as we can. So the probability of reaching and being consistent with it, which is where ongoing advice for a lot of clients gives them peace of mind, because you might need to pivot and change to a different situation, can be extremely valuable. So what do we do after this point? Well, you go into decumulation. So when you're at the point of retiring, and you've done all this mapping out, or you've planned it out, or you're now just at the point of retirement and think of, I want to just make sure I can start, and you turn on that tap and you start decumulating. So again, there's different tax rules and things around this. So if you want to start taking money from a pension, you do have to be careful with if you wanted to keep adding money into a pension, you can trigger a thing called money purchase annual allowance, and that can have an effect on how much you can put into your pension. So for some people, they might do like a partial retirement, and we just need to make sure that's not going to be affected. Or it might be that we need to make sure that if they're going to fully retire, they're aware of what this, you're aware of what this situation is going to be, because you might not be looking to save going forward. And a key thing is when you do retire, there's going to be no other income from employment unless you're partially retiring and you're doing part-time, which is becoming a lot more common, to be honest. If you're sort of setting a line in the sand and you go, right, that's where I'm done and I want to retire, you need to make sure that pension is not going to run out, but also you're going to have no means of topping that up if times get difficult, which is why it's important to stress test the situations to make sure that you're going to have no other income coming in other than your pensions that you've got, unless you went back to work. And for a lot of people, that's just not an option. If you're starting to get older and you've had a manual job, you might not be able to. So what do we do? Well, a few things we do is, firstly, we want to make sure we've got 2 years worth of cash buffer as a minimum, really, in liquid assets or investments. So that is just cash, or it could be in money market funds, I won't explain what they are. I can touch those on an investment type talk that I'll do. But essentially, 2 years of a cash buffer is ideal. Now, that doesn't necessarily mean that you save up 2 years. If you can, brilliant. But if you can't save up, it just means that we take some of the pension and we put that into a cash account, or move it into cash and leave it within the pension, but it's there to access. And why do we do this? Well, we do it fundamentally so that if markets were to drop, when markets because they inevitably will, when they do dip down, what we want to make sure is that the cash is being able to used instead. So you kind of switch your pension tap off and you turn on the cash tap instead. And the reason why we do that is because when pensions drop or investments drop, we don't want to deplete the pension pot any faster than we need to. And if investments are lower in the market, you're having to sell off more units than they would if they were where you want them to be or higher. So you just need to make sure that we've got this cash buffer to be able to kind of switch between the two. And why do we do 2 years? Well, most markets recover within 6 months to a year, but the extra year is just so that we've got that fail safe, so that if it is taking longer, we can keep using that. Then when the markets recover, we then switch off the cash tap and we turn back on the kind of investment pot as well, or the middle pot here, which is sort of conservative type investments with potentially slightly high return or high returns than you would get with cash. And there's no real scope for taking much risk. We just need to be trying to tackle inflation to maintain that as best as we can. So inflation erodes the purchasing power of your money because costs and services just get more expensive. So we want to make sure that that is just maintaining its value, because the cash pot will be depleting. Even though the money won't be going down if you're not spending it, it will be going down in its value. So the middle pot is really all about conserving what you've currently got, but we need the cash pot to be able to switch between the two. And then the last one is to offset the fact that cash is causing a bit of a drag on your investments. So what we do is we have one pot that's potentially exposed to slightly higher risk, and that will be more in equities or equity-based investments. There's potentially more volatile, but also it means that there's potential for high returns. And because there's that potential for growth, it means that then we're not causing too much of a drag on the overall outcome of the pension pot and sustaining it as best as we can. So you kind of split it between three. You've got your cash, which is there for kind of your emergencies or if the market dips to withstand it. You've then got the middle one, which is just to maintain your main bulk of your pension pot. And this is where you'll be receiving pretty much most of your income from going forward. The cash pot's just there as a buffer. And then you've got the other one, which is to offset the fact that you've got cash to get us to try and get growth, so that then we're actually getting a bit of returns on the investment pot to try and get a little bit of growth if we can. And the pots will essentially move down. So as you're working through, you'll need to start moving money from the growth pot, the one that's potentially more volatile but with the higher returns, so the last one, you start moving that down into the sort of more conservative pot in the middle. And then if you have depleted the cash pot at all and markets recovered and you're sort of getting along okay with things, you then move it, you start topping back up the cash pot as well. And that's where the growth pot can be quite powerful, because if we didn't have the growth pot, we might not be able to top up the cash pot after we've had those sort of year or 2 years of needing to spend it. So that's a way that we kind of segment it. There's lots of different ways in which you could do it, but that's one method if you're needing to take regular income from your pension. Other methods that I've done with clients as well, instead of just using the three sort of pots, some clients go, well, I'm actually quite comfortable in being able to use my state pension, or I might have a defined benefit pension that gives me regular permanent income for the rest of my life. And when that kicks in, I'm happy. So at 67, let's just say, that all kicks in and it's no problem at all. But they're actually wanting to retire at 65 because they've just had enough of work and they just think, well, I've had enough. Or they might even be partially retired now in the sense that they're working part-time. Well, sometimes if you've got a pension pot, you can just use that pension pot and chop it into like a couple of years. So if it's 65 and you think, well, that's 2 years before I want to retire, you just chop that pension pot and use that pension pot to cover those 2-year gaps. That can then mean, yes, you're depleting the pension pot to zero by the end of it potentially, because if you're utilising all of it, but it gives you the opportunity to retire 2 years sooner than perhaps you would. And it's kind of a way of bridging the gap. You can do this if you've got a bigger pension pot. You could do this for 5 years before retirement, 6 years, however much you've got. You just have to be aware that once that pot's gone to zero, you're then dependent on what that regular income is that you may or may not receive for the rest of your life then, because there's no more unless you're planning on to try and go back to work or whatever the situation may be. So that's kind of another method. But the one with the pots that I explained is very much for people that want to receive a consistent regular income. And because defined benefit pensions, which is where you get those regular income or final salary ones, are becoming so rare and few and far between now, it's you can't really bank on them. Like, people who are coming into the workplace now are just not going to have them, to be quite honest, unless they're either going into the NHS, and even the rules on those have changed, military, which the rules of those unchanged, they're not as good as the once were. So having your own provisions is extremely important. And what we want to make sure is that those provisions are going to sustain you. And this is one methodology in being able to do that if you've not been fortunate enough to get a final salary pension. So what other tools can you use, just to start to wrap it up? You have essentially pension, which is fit for the job. Obviously, I've gone through that now. We've got property income. So if you don't have pensions, what other assets do you might have? You might have a rental income. You might even have your residential property that's mortgage free. You can do certain things in very specific situations for the right situation. So I wouldn't just throw yourself into it. You can do like a lifetime mortgage where you can release equity from the home. And if you've got no dependents and you're wanting to make sure that you've got some capital to bridge a gap to retirement, you can utilize this. Again, I can do a separate video. I'll be doing a separate one on mortgages specifically, and I might wrap that into it. But that's just an option. And if it's suited for your situation, you just need to make sure it is correct. Then you've got lifetime ISAs. This is kind of an alternative tool that you can use for pensions. Pensions are the gold standard, but a lifetime ISA you can use. There is rules around it. And on my website, if you need to have a look, the different types of ISA you can see on there, and I'll explain the rules and what ages. It's like between 18 and 39, you can set one up. And then you can essentially get like a 25% government bonus. A lot of people use it for purchasing the first home, but it can be used towards retirement planning. So if you're fortunate enough to be maximizing your pensions, this is another way of then doing the next best thing and utilizing as much as you can from ISAs. Then you've got cash, which is kind of a necessity. You might just have cash in the bank account, which, again, there's nothing wrong if you have money or inherited money or anything that you use that cash in the bank to bridge 2 years of gap. It doesn't need to even be as complicated as putting it into a pension or investing it. It's just that is the most optimal way. But if you've got 2 years worth of savings in cash and you go, well, my state pension kicks in 2 years, I'm just going to use this cash for 2 years to bridge that gap, you can. All I would say is make sure you've got enough cash reserves when you do retire to fall back on, just in case of emergencies, because then there's going to be no other buffer. And the last one is businesses. So sale of businesses. There's quite a few clever things that you can do if you've built up a business or someone's self-employed, and instead of just wrapping the business up, potentially look to sell it. And if there's a revenue that can be generated from it, or even sort of succession planning, can you put somebody else in the working seat of the job, and can you actually turn around and go, well, I'm no longer going to be running it. I'll be taking a very modest income from it, but if it's a limited company, I'm still going to be a shareholder, so I'll be able to receive the income from the profits and structure it that way. So again, that's a whole other conversation around businesses and business planning as a whole. But sale of a business is quite a big one that a lot of people kind of overlook. If you are self-employed, and in the early years when you're setting up a business, it can be very, very tricky. So a lot of people don't even consider putting into pensions, but you can start to do certain things with pensions, and you can kind of with businesses, and you can kind of combine the two and start using certain type of pensions to actually aid your business, and your business to aid your pension, like with certain self-invested personal pensions as well. So just another one to think about, really. And there is other tools and other things that you can use, but that's just some of the really basics around it. I mainly wanted to focus on retirement planning with pensions because that's where most people are, but not to forget, if you are in one of these other situations, you've still got other assets and things that you can potentially look to build upon, or if you just prefer property as an example. I'm not biased if somebody wants to use property or pensions. I'll deal with both. I can advise on both, so it's completely up to what that plans out and how that looks as a whole. So just to wrap it up then, we have covered why plan in the first place, why and the different reasons behind it, essentially, when to plan, how to plan and what the 4% rule is. And if you want to get more fancy, you've got cash flow modeling, which you may need to do through an advisor. There is tools that you can do by yourself if you have a scooch around on the internet, and then other different types of investments that you could potentially use as well. So they're just a few things for you to sort of consider, and hopefully that's been a bit helpful to be able to understand what you need to do towards your retirement and how to plan it out. Anything that I've kind of explained of budget planners, again, let me know, and I can email you one or just drop me a message. Or also, if you need any sort of help with anything, just let me know. But hopefully that gives you some basic understanding on how to plan things out. So all that being said, thanks for watching, and hope to catch you on the next one. Thank you.